We are thrilled to have Chief Investment Officer of Fitz-Gerald Group, Keith Fitz-Gerald. Keith is one of America's most widely read, respected investment experts and financial media personalities. With 1,200 plus primetime media appearances to his credit on the Fox Business Network, CNBC, Bloomberg, and more, and 37 years in global markets as a trader, investor, and analyst, it's easy to understand why more than 1 million readers, viewers, and subscribers depend on his research. Keith, thanks so much for joining us.
It is my pleasure. Thank you so much for having me. This is going to be a really interesting conversation, everybody, because we get to talk about something that's near and dear to my heart, private placement memorandums, and specifically how to know when to stay and when to walk away. Those are two things that really people don't talk about a lot. They tend to just get very, very excited about the deal, whatever the deal looks like, rather than asking some of the questions that they probably should. So anyway, my presentation style is pretty much a relaxed one. So what I'd like to do is I'd like to encourage you to ask questions. If you have them, please put them in the chat so I can see them. Please let me know what's on your mind, and it can be related to PPM, some of the stuff we talk about, and also just in general markets, because we're living in interesting times. So if I can provide some insight to you, I'd be more than happy to do it. Let's get rolling. So first things first, thank you so much for being here. Again, we don't get an opportunity to do this as often as we like, and the virus has clearly changed the world we live in. I don't know about you, but I hope that you are safe, healthy, and your loved ones are the same wherever this presentation finds you. Today's market conditions were certainly something that raised a lot of flags in my view. I was on Fox Monday morning talking about that, saying, for the first time since March, I'm a little concerned that the narrative is changing. And that's very, very important because, when it comes to PPMs, private placements, equity deals that we're looking at, the one underlying factor in investing is that you want to do it in a positive fashion. You want to invest in optimism, but more importantly, you want to invest because you're going forward, because you want to make a future and you want to make some money. And that's very easy to do when hope is the driving narrative, as it has been since March. But it's very tough to do when the narrative gets hijacked by either rising virus counts or, in some cases, civil unrest. Now, there are clearly a lot of conversations that this country needs to have. Perhaps we should have had for years, but we haven't until recently. And, I'm not going to get into what's right, what's wrong. My job is to help you be profitable. So the thing that I want to impart today is, again, we want to be very focused on what it takes to move forward. Let everybody else worry about what it means to be right. Our job as investors is to be profitable. And talking today about private placement memorandums, for example, and specifically some of the things that I've picked up over on the years may be helpful, particularly those things when to stay, when to go away. So let's do that now. Before we get going, we need to address the lawyers in the room and all of the risks. This presentation is for your exclusive consideration. Every investment out there has risk, period. It is impossible to guarantee future results and or profits. And furthermore, past performance never assures future results, and you can lose all of your money or more in any investment. So with that out of the way, I think we've got it. And let's get rolling. This is like sitting in an airplane. We have to say yes if you're, in the emergency exit windows. And I can't recall when the last time I was on an airplane, last February. Normally, I'm flying somewhere every single month, every couple of weeks. And this has been the longest I've been in one place, and as long as I can remember. Flying actually used to be kind of fun. It's going to be very interesting environment when we get back into those airplanes. All right. Now, when it comes to private placement deals, we've all been there. I think it's very fair to say we've all been there. And what I mean by that is if it sounds too good to be true, guess what? It probably is. Now, I want you to put your hands up or type yes or something if you have felt this way too. If we were in a conference room, I would be asking you to stick your hands up, and I'd be putting both my hands up in the air, frankly. We've all been there. We've all been to the school of hard knocks. So how many people out there have been there with me? Give everybody a minute to see if this thing comes through here. We'll test the limits of interactability. Well, regardless of whether we've all been there or not, the thing about this is that it is not your fault. It's not your fault. It just isn't. And the reason for that is that private placement memorandums, the things that they use to circulate deals and determine whether or not you want to invest, are among the most complicated documents in the investing world. I mean, they really are. They are not simple, and they're designed that way for reasons I'll get to in a minute. But the problem is they're not just complicated, they're filled with legalese. And not coincidentally, when you put all those words together, they look like a pile of something else that I'm not going to mention here because this is a family-friendly environment. But the point is, unfortunately, private placement memorandums, PPMs, and looking at private deals, you can't just speak clearly because the courts don't like it. The courts have a language all their own, and we're kind of in a tough spot when it comes to being investors because you got to sort through that. Now, generally speaking, there are 4 parts to any private placement memorandum, any offering, special purpose vehicle, etc. There's the introduction, which is pretty straightforward. It's a summary, it's minimum investments, risks. Suitability statement is a big one. They try to define what it's suitable for and who it's suitable for, and fees. Then you get to disclosures, which of course never seem to disclose everything. That's projections, preformas, proformas, potential returns, but also risk, challenges, legal and tax issues. And then of course you get a legal agreement, which is, governing rules, who owns what, structure. Is this an LLC, a special purpose investment vehicle? Is it something else? Is it a corporation? What is this thing? Are you making an angel investment? Is it really a warrant? What are you doing here? Termination, which is really odd because in this country, you've got to plan for marriage and divorce before you enter a business deal, which is really strange. But unfortunately, that's the situation we have to deal with. And then finally, rights and buyouts. And then of course, there's actually the subscription document. How many shares are you getting? What are the funding instructions, requirements? All that jazz. I refer to this, after years and years and years of experience, is the anti-marketing document. And it's really complicated. Some of these things literally in recent years have become half an inch thick, an inch thick, maybe several documents because they're too thick to fit the blasted stapler through it. But that's a sign of the times. And, thick or thin, it doesn't really matter. What you want to look for when you start doing this, and this is the interesting part, there are generally 4 questions, regardless of any deal, that you should look at. And every investor should ask, but very few do. And this is the beginning of, when to stay and when to walk away. The question you've got to ask yourself is, what are you really buying? It doesn't matter what kind of deal you're talking about, but what are you actually buying? Is it a product? Is it a service? Is it the fact that you want to be able to talk about it at the country club or at your next breakfast party or next gathering in the backyard over barbecue? What you're buying and why are not always the same answer. And again, these are questions that I picked up from the School of Hard Knocks. You want to ask yourself, even if nobody else asks, and even if they're not spelled out in the document. The next thing you want to think about, and again, this is something that not a lot of people stop and think about because, you all get really excited. I get very excited when I see something I really like. But what's the standalone value of whatever it is you're looking at investing in, and when? And that's a really good question because nobody actually knows what the standalone value is. And if you look at the private placement, many of them will try to convince you this thing is the next greatest since canned beer or sliced bread. But that may not be the case for years to come. So you want to ask yourself, what really do you expect to see in terms of valuation, and when do you expect to see it? Is this a deal where you want to see results in a year, or is this a deal when you want to see results in 5 years? And then, are there any potential skeletons in the closet? Now, normally that is referred to as, do the operators, do the offering, do the subscription agents have those skeletons in the closet? But you might have some skeletons in the closet. And let me give you an example. If, for example, way back when I got burned very early on a deal. So my skeleton in the closet had nothing to do with the next deal I was evaluating. It had everything to do with the deal that I just gotten burned by. And so I was skittish, and maybe I wasn't thinking as clearly as I thought I could have. And so I wound up passing on what turned out to be a phenomenal private placement. So it was one of the great mistakes that I've made personally, in that I left a lot of money on the table because I walked away from a deal that I otherwise probably shouldn't have gotten involved in. And I got involved in a deal that I probably shouldn't have because I didn't ask these questions. Which brings me to sort of the final fourth one here on this slide. What's the walk away price? Now, what I mean by that is, what price very specifically would it take for you to walk away? You know, does that have to be too rich, too little, too inexpensive, too expensive? Where are you going to walk away? And that's very important, because not every investor defines the victory conditions or the failure conditions. You need to know what your figure is ahead of time before you sign on the dotted line that says, I'm going to be into this thing, or you know what? I don't like it and I'm walking away. What is that number? Now, everybody has that number. A lot of people don't realize it, but you do. And that's important, especially as accredited investors, because we get approached by a lot of folks wanting funding for a lot of different stuff. And again, we've all been there, so it becomes problematic in terms of evaluating. You really have to answer these 4 questions to know when to stay or when to walk away. Now, the tough part about this is you can ask these questions, but if you're not honest with yourself, you're not going to improve your position. You're not going to improve your results, because every answer to these questions can make or break a deal and or your bank account, sometimes both at once. And clearly, you don't want to be in a position where that happens. You do not want to fail to answer one of these questions honestly, because if you do, the consequences may have very real and problematic impact on your future, economically, philosophically, monetarily. And again, so be honest with yourself is really important. Now, the other thing that's really interesting about this is that you've got to learn to evaluate these transactions very succinctly. Because chances are, again, if you're an accredited investor, you're going to have a lot of opportunities. You're going to see a lot of things that you wouldn't otherwise see if you weren't accredited. So again, you gotta learn to evaluate this. Now, let's talk for a minute about what it takes to do that, and then we're going to jump into some of the very specific warning flags that I've seen in deals over the years that have caused me to walk away and or to stay. Remember, start with those questions, ask those 4 first. Be honest with yourself, then take your meter, and you know what meter I'm referring to, the one that starts with B and ends with T. Have your meter on the highest possible settings. Here's what I look for when it comes to specific deals. I look for deals that have high returns promised with little or more no risk. That is a huge red flag to me. The best PPMs, the best deals, the best projects, investment opportunities almost never promise high returns with little risk. In fact, the exact opposite is true. They start with, hey, this has every risk in the world. And you know what? If we do our jobs right, then we're going to have high profitability. But the ones that start with profits and then finish with little or no risk, you know what? I generally walk away from those. I don't even get past the first page. But if all of a sudden I see a document that says, hey, you know what? We've got something really interesting, really cool, really unique, really, whatever it is, and you could lose everything, but we're very excited about it and we're doing this project anyway, and we want to talk to you about it, that's something I'm going to pay attention to. The second red flag for me in terms of when I'm going to walk away is unregistered sales. Now, in the old days, the idea of buying oceanfront Arizona, oceanfront land in Arizona existed for a reason, because there really were unscrupulous, unregistered sales reps who were selling, land certificates to tenderfeet in New York City back in the 1800s for, quote, oceanfront land in Arizona. Some joker also sold apparently the Brooklyn Bridge or London Bridge. I can't remember exactly the story, but you just don't know if the rep isn't registered. Now, in other countries, it varies as to what kind of registration they may or may not have. But here in the United States, you want some sort of registered sales rep, generally speaking. You don't just want it to be a friend promising you a great investment. Although, again, to be fair, some of the best deals I've ever made have been over a handshake and we get around the documents later. So you've got to make a judgment call there. It's not a formal private placement. It's more like an angel investment to start something. We're talking about private placements. So there is an expectation by the time the process has gotten to that point that the lawyers are involved. There should be formal sales documents. There should be registered sales reps. Anybody's offering to collect a commission for introducing something and they're not registered, that's a big red flag. Now, this one's interesting. Once in a lifetime or groundbreakingly new. Normally, that's a stay away if they can't articulate what they're doing. On the other hand, again, Apple started in a garage, HP started in a garage, Intel started in a garage. Many of the great tech companies today started in somebody's backyard in a garage. Look at Facebook, started in Zuckerberg's dorm room. Once in a lifetime and groundbreakingly new does not have the negative stigma that it used to. So many of the private placements, in fact, today are going to talk about groundbreakingly new processes or products or technologies. The key there is making sure that it's functional, making sure that it's real, making sure that somebody's thought through it. So even if it's a pile of code or just a concept, what you want to do is you want to understand what the promise is. Because if you can't understand the promise and it can't be articulated in a single sentence, then I would submit the founder or the seeker of funding hasn't really thought it through. And unfortunately, you do see a lot of those things. Just because somebody can pay the lawyer's fees and have it translated into a document does not necessarily make it a once in a lifetime deal or groundbreakingly new worth your money. It might be new and it might be once in a lifetime, but again, that does not mean it's worth your money. And that's the question. So that's the red flag and the green at the same time. The other thing that's important, the next feature, quality investments will not have a time constraint, but plenty of marginal ones will. If you see a deal where you're getting pressured and somebody's got a PPM in front of you and they're saying, hey, you got to sign here by Tuesday or the funding's going to go away. I just saw one of those 2 or 3 weeks ago and I ran the other direction because they try to put high pressure sales tactics on me, saying, oh, there's lots of people, it's fully subscribed, we'll make special arrangements for you, but you got to decide by the end of the week. Well, no, actually, I didn't have to decide by the end of the week. The gentleman wanted the deal closed by the end of the week, but that didn't meet my time framework. So I walked away. And again, same kind of thing. You want to think about it. You want to walk away if you run into this kind of situation, particularly if you're being pressured. The other one seems very old school, but it's very real. If there's typos, spelling, or biographical errors in there, you know what? That tells me they haven't spent the time or energy needed to review the documents appropriately. It calls into question everything else out there. If they can't get something as simple as a name or a spelling correctly. Now, granted, I'm not perfect. I unfortunately have to rely on editors and some of the stuff I do, and those kind of errors get out there. But when it's in a legal document like this, presumably that's been read 100,000 times before it gets to your desk. So if you see it, question it. And then finally, the other thing too, well, not finally, but no defined income requirements or net worth requirements. That's a huge red flag because they're just looking for money no matter what. This is not far off from the Nigerian Prince email scam. Nobody really cares what you have as long as they get their hands on it, run the other direction. And then you get to solo operators and operators with limited relevant experience. Now, this is a big one because it's come on the scene recently. There have been a lot of cryptocurrency and cannabis operators who fit this description. These are basically cowboys who are trying to come in and make a fast buck because the markets have been receptive to it. Doesn't mean that these are bad people. It doesn't mean that you can't make a pile of money. What it means, though, is that you've got a lot more digging to do, a lot more diligence to do to figure out what's the diamond in the rough. Because for every one company that makes it, there are probably 1,000 out there that don't. And again, anybody can find a lawyer these days who will write up an offering document. But unless it's very properly prepared and it's done right, you want to go the other direction. Big one, and believe me, I've seen this, offices. A lot of times they list offices. In the old days, we'd actually go look. We'd try to find out where their offices were. Now, these days, that's harder to do because, you've got the internet and a few clicks of a button, you can figure out where somebody is or isn't officed. But in the old days, that was kind of hard, particularly if you were talking about Goldfield somewhere or a robotics lab overseas. It's very hard for onshore investors to go verify that information. But these days, It's pretty straightforward. So that's rare, but still a red flag. You want to just sort of make sure you know what you're dealing with and who you're dealing with. Which brings me to unverifiable bios and pressure. The shadier a deal is, the higher the pressure is going to be. So you want to make absolutely certain that you don't fall into that trap. And again, that's a big red flag for me. Now, there are 4 special things that I want to talk about now. Those are the obvious red flags. Now I'm going to talk about the hidden stuff, because these are the gotchas that, again, from experience, nail a lot of people unsuspecting. So these are also, in addition to questions, there's sort of 3 layers here. Questions you want to ask before you get into a deal, red flags you want to look at, green flags you want to look for before you get into a deal, before you sign the bottom line. Or that's sort of what we just covered. And then finally, this is kind of the last layer of things you want to talk about with your lawyers and your financial professionals, because you never want to do a deal like that without talking with those people. And here's what to look for. First thing you want to look for is liquidation. Not every agreement spells this out, but I, in my opinion, think they all should. And what you want to be asking and looking for when it comes to liquidation is, can you get out of a deal, and how does that have to happen? Is there a minimum holding period? Do you have to have permission to sell? Can you transfer, or do you actually have to do a sale to keep you in the deal? Can you separate part of it? Is there also the provision for additional capital calls? Now, in the old days, that used to be a huge gotcha. People would sweep that in, you'd sign on the bottom line, think you're doing great, and all of a sudden the partnership or the business operating entity would need more money, and you'd be on the hook, even though it wasn't very clearly spelled out. So that's a big one. And it usually comes into the funding provisions and or liquidation, because if they don't get the funding, then they could say, oh, we don't have enough money, and we walk off into the sunset. Their saddlebags have your money in it, and they'll just say, well, we didn't get our capital call, so we're out, but they still keep your money. Not a good mix. The next thing you want to look for is fee, revenue, and cost splits. Now, 80-20, 70-30, there's some number in there somewhere, if it's a PPM or a special purpose business vehicle, because you want to have an incentive for these folks to earn money, just like you're going to earn money. But the key is you want the incentives aligned evenly. I've seen plenty of documents over the years where the general partner gets all of the money and the limited partners don't receive anything. What you want to do, my preference, particularly if I'm dealing with drilling agreements, or I'm dealing with mining agreements, or I'm dealing with intellectual property agreements, my preference is to see deals where the investors are taken care of first, then the GPs get out. So that's a deal I want to pay attention to, because then the GP, the sponsor, the managing partner is saying, you know what, we understand this is risky, but we're going to pay you first, then we're going to pay ourselves. That speaks to a lot of confidence, because again, you don't see that unless the executives involved are very confident in their ability to deliver. So I kind of like that. And then the other thing that I do like is something called a waterfall split. And what that means is, it's basically a payment incentive. As the profitability increases and certain specific revenue hurdles are met, or cost hurdles, or developmental hurdles, like in a pharma deal, for example, then the profits tend to go up. Again, if everybody's doing their jobs and they're going in the right direction, I have no problem whatsoever with that kind of arrangement, because everybody's lined up. The other thing, and finally on this, is you want to make sure all anticipated fees are specified. Now, you'll never anticipate everything in every document. That's why the legal system is the way it is. But you can do a darn good job ahead of time anticipating what most of those fees are going to be. And, again, this has been around long enough that, again, we'll see it. We can figure it out. And then finally, indemnification. This is a big one, particularly if you're dealing with tech, you're dealing with data security, you're dealing with pharma. If there's a human risk to whatever it is you're working on, you never have a document where this isn't clearly spelled out. You want to have indemnification, because you don't want to be on the hook for something that somebody else does, particularly if it's stupid, illegal, or immoral. And these things, again, hopefully you never are involved in a deal where that becomes an issue, but this is a way you check on it. You want to make sure you have your buffers up. You want to understand those boundaries. Again, this is very, very important. Why you talk, I suggest, with lawyers and financial professionals before you do any private placement. because you don't want to take a chance on this. Now, PPMs can be really great investments, so don't let these red flags put you off. It's really cool because particularly in today's environment, they're better understood than they used to be. You have access to some great opportunities. You have relatively low entry barriers because there's some really cool deals out there. And finally, you've got terrific profit potential. And in today's markets, I submit that it's not just diversification by stocks, it's diversification by investment method, by product, by what you're doing. And as an accredited investor, you have a lot of opportunity available to you that normal investors do not. So, PPMs, again, can be really great, but I cannot stress this enough. Do not invest in any PPM unless you check with your lawyers, your financial advisors, your accountants first. Every investment involves risk, and it's impossible to identify all the risks in advance. That doesn't mean you can't do a good job, but that's why you want to look. So we've got a couple minutes left. I'd be happy to take any questions you have, and why don't you throw a couple of them into the chat area if you don't mind.
Hi, are you there?
I am.
Great. There are no other questions right now in the chat.
Oh my goodness. All right. Well, I can't possibly have spoken that clearly or that eloquently that there aren't any questions. So
actually, you're very thorough.
Well, I tell you what, here, everybody, if there are any additional questions, feel free to reach out to the Money Show folks. They'll make sure they get to me. You can also reach out to me either on Twitter or through my website. But thank you, everybody, for being here. Thank you for your time. Thank you for your interest. And I wish you all the best in health and wealth. And I will see you next time.
All right, Keith, thank you so much for being here today.